on the surface that sounds fine, you know, as long as your income is holding up. But in fact, people's incomes were falling at least as fast. Income is falling at the rate of 36%. Prices are falling at the rate of 27%. So even though the price of a loaf of bread has gone from 25 cents to a nickel, many people didn't have a nickel. You know, so so then the baker had trouble selling a loaf of bread at 5 cents. And so that was the situation that our economy, our forefathers were in. I've read an interesting book recently by a guy named Ted Gupp. I think he writes for the New Yorker or the New York Times, that he's a freelance writer, but he grew up in Canton, Ohio, but his grandfather had been a businessman in Canton, Ohio. He had an interesting life history. But he ran a clothing store, and he kept the job, you know, he kept his clothing store open throughout the 30s, and he had a little money. So in 1933, he put an ad in the local Canton newspaper where he said, you know, if you're down on your luck, you know, I'm willing to give $5, you know, to people who write in with their story and you know, need a little extra money now at Christmas time and so forth. And so this guy, Ted Gupp, had actually found the letters that had been written to his grandfather by people living in the Canton area who'd seen his ad in the newspaper asking, if you can find me a job, you know, I'd much rather have a job than your charity, but I've got kids here who don't have shoes to wear to go to school, or, you know, we have trouble putting food on the table. And so, you know, his grandfather would, you know, get these letters, and he would write them a check. He did this all anonymously. He didn't, you know, it was all done. It's a really interesting book, and you kind of get the personal stories about what a lot of people were going through. And some of these people had been very successful business people, you know, or you know, one guy was a painter, you know, he couldn't find any work painting, you know, and other people, you know, were down on their luck for other reasons. But anyway, it's an interesting book. Anyway, I digress. So, you know, I showed you the diagrams now, previously showing GDP relative, during the recent recession, relative to what it had done during our prior post-war recessions. Now let's compare it with the Great Depression. Compared to the Great Depression, what we've lived through doesn't look nearly so bad. So the red line here is the recent recession. GDP lost about 5–6%. We're now back to about where we were at the start of the recession. Here's the Great Depression. Again, the 36% loss in GDP. 4 years out, we're still at the bottom. Employment. We've had a terrible experience with employment in this recession. We lost an unusually large number of jobs, and those jobs have been very slow to come back. Here's the Great Depression. Lost 25% of people were thrown out of work. And it was not really until we turned the corner starting in 1933, started getting some employment growth. But it was World War II before the unemployment rate fell below 10%. The price level. As I mentioned, that during this most recent recession, prices in general have tended to continue to rise. Now, of course, we've seen it at the gas pump, where prices have gone up and they go down, and they go up and go down. But generally, they've been rising. But other prices have come down. You know, the prices of cell phones and iPads have continued to fall. So on average is what we're capturing with the inflation rate. On average, the level of prices in the U.S. economy has been growing at a pretty steady 1.5%, which is a roughly equivalent of price stability measured by the Consumer Price Index. We had tremendous deflation during the Great Depression, however. Prices everywhere were falling. And again, it was not until the mid-30s before that started to turn around. And that turns out to be an important difference, and I think an important reason why the Great Depression was so great relative to even what we have experienced recently. It's that deflation aspect of it. So let's talk about the government's response. The Fed responded much more aggressively in the 2007 to 9 period than did the Fed in the 1930s. The Fed set up special credit programs for banks and other financial firms. It cut interest rates, cut our own federal funds interest rate target that we have a lot of influence on. That's been cut to 0 now for 2 years. We've been engaged in this QE policy, quantitative easing, buying lots of government bonds, putting them on our balance sheet, and that pumps money into the economy. So, you know, to keep the economy moving as much as we can. There's the famous or infamous TARP, the $700 billion TARP that Congress fought about in the fall of 2008, that the Congress eventually passed and President Bush signed into law. That helped recapitalize our banking system. It kept it afloat. Money market mutual funds I mentioned. Well, the Treasury stepped in with a temporary guarantee program to help discourage people from withdrawing their money out of the money market mutual funds. Very much like FDIC insurance for our bank accounts. The FDIC insurance was expanded from a $100,000 limit up to $250,000 to cover more people. Again, to strengthen our banking system. We had the stress tests where the largest banks in the country were given special examinations by the Fed and the other banking agencies to make sure that they were in sound condition. If they weren't, they were required to put additional capital into their organizations. We had the Dodd-Frank Act that was passed last summer, 2010, which imposes a lot of new regulations on the banking system and on mortgage brokers and so forth. It's been a mixed bag, but that's something that was a response by the government. So I mentioned the Fed has cut interest rates to zero. We did that in December of 2008. We've kept them at zero ever since then. Extremely accommodative monetary policy. This chart is a chart of the Fed's balance sheet, specifically the assets held by the Fed. So here in the fall of 2008, the Fed's balance sheet size had basically been constant, and actually growing slightly over time, but on this scale it shows it as constant. But then beginning when the big crisis hit in the fall of 2008, we had a lot of emergency lending programs. Since then we've been buying government bonds and mortgage bonds issued by Fannie Mae and Freddie Mac. That's been pumping cash into the economy. And all of that has served to keep the money supply growing. M2 is the broad measure of the money supply that includes not only cash and coins in your pocket, but also your checking accounts and your savings accounts at banks. So that money supply has continued to rise. That's the blue line here. The monetary base consists of currency in circulation plus the reserves that commercial banks are holding at the Fed, at the Federal Reserve. So that is a more narrower measure of what the Fed is doing to put liquidity into the economy. So the Fed increases the monetary base by buying government bonds, by making loans to banks, and that in turn keeps the broader money supply going up. That was very different during the Great Depression. In the 1930s, the money supply collapsed, even though the monetary base, that is currency in circulation plus bank reserve deposits, were rising. So that's a contrast between the 30s and the present, which again I think is important to understanding why our recent experience, as bad as it was not as severe as the Great Depression. So this is just reiterating, summarizing what I've already said in terms of what the Fed did this time around. Now let's talk about what the Fed did during the Great Depression. This, by the way, is the New York Stock Exchange. I just grabbed a Great Depression picture. So we had the stock market crash in October 1929. Big, massive event, and a big Fed response. The Fed increased the money supply, rescued the stock broker companies and so forth. And so the stock market crash, per se, didn't turn out to be a big deal. But the Fed didn't follow through in going into the 1930s. In the early 1930s, there was a series of banking panics. So I described the events of people losing confidence in the money market mutual funds. The parallel was in the 30s. Again, no deposit insurance, no FDIC. If people started worrying about the safety of the deposits of their deposit in their bank, then the sensible thing is to go get that deposit out in the form of cash and stuff it under your mattress or bury it in a coffee can in the backyard or do anything but keep it in a bank. Banks were not safe in the 1930s because so many of them were failing. They were going out of business. One day they were here, the next day the door would be shut, and with it, your money was gone. Okay, so you're not going to keep your money in an institution like that. And so as a result, there were these panics where depositors would just line up, and as soon as the doors open that morning, they go in and take all their money out.